How are you, folks? Enzo DiCasanzo, clinical professor, economics and finance in St. Peters, New Jersey City. And today we're going to be working on another part of our tax discussion. We're going to be working on a Wall Street Journal article, taxable income, and another federal income tax example. And for assignment number 2, yesterday's lecture and today's lecture will cover. So there's not going to be a specific video for assignment number 2. It's just going to be watching these 2 lectures and applying what you learned, which is a big part of what goes on. So just always keep that in mind. Okay. All right, let's get to it. So another Wall Street Journal report. This is from the tax report section of the journal. It says, "What will 80 billion more for the IRS mean for your taxes?" Which is a question that's on probably most of your minds. I made the questions for assignment number 2. I'm looking at this, and there's always like more questions. I might add a little bit of I like this one. See what it says, how many hires and what's the current workforce, and this is something that I haven't seen in too many different places, but how many retirements are expected in the next couple of years too. So we're gonna this is a good account, and this is recent. This is just a few weeks ago. So the Inflation Reduction Act, well, that's we all know that sounds very nice, but outside of sounding nice, that's about all it sounds. It said it won't bring 87,000 new IRS agents with guns to your front doors, but has important changes for taxpayers. This media account goes through, and we have the numbers for the armed enforcement people. How many? That's like a quarter of the workforce, or maybe even less. It was a quarter at one time, and in a good year, it was a quarter. It was down to maybe an eighth. So you're talking about maybe 12, 13, 14% of those 80,000 something, federal employees. So, you're talking, so a couple thousand, you're talking about 10,000 or 12,000 or whatever it's going to be. And there's going to be retirements. And again, and a lot of your parents might be firefighters or law enforcement, or you work for the courts or something. People don't stay in those jobs until they're 80. There's always an unusual person somewhere who stays a very long time, but generally, of the biggest percentage that you could think of, want to get out in 20, 25 years and get on with their next, whatever their second career is going to be, kind of a thing. So the tax report came out just as Congress took up the Inflation Reduction Act, which I'm not going to talk about too much in this particular course because I think it's just nonsense, and discusses the bill's 80 billion provision, or 80 billion proposed new IRS service funding. Over half the new dollars were earmarked for tax enforcement, especially audits of high earning taxpayers, while the rest was to improve operations, technology, and taxpayer service. So of that 80 billion or so, what are we spending? What are we spending in terms of this? Folks, stand by 1 second. Sorry. Sorry. Okay. Yeah. So anyway, again, it's just looking through this, just some questions that are sort of rolling off of my head as I'm sitting here. New tax enforcement, operations, technology, taxpayer service, and we have to remember it's still to serve the people, the federal government. It's not supposed to be adversarial or anything like that. But so that might be a question in terms of what potentially could you spend that 80 billion on over a decade in terms of the specifics, operation, and that whole list that's right before us. So signed the bill in August. The details moved around a bit. And it's going to be spent over a decade. And actually, this we spent over a decade. She needs to uh, emphasize that. Supporters of the law have long complained the IRS appropriations have been too erratic to fix fundamental problems. It says 1960s era technology are pleased with the stable funding. Again, I don't want to go on and on in this particular video, but I do recall past past engagements in the past for in my work, and JP Morgan, big name banks who were in this boat, maybe not 1960s era, but maybe 1980s era. And that's forever ago in the computer technology world, how much things have changed. We would need to just stop all commerce and stop everything, stop buying gas, stop buying stuff at Walmart, change all the technology, which would probably take about 10 years, and then pick that's what you'd have to do. This whole rolling along thing is very difficult. But how do you just freeze the world for a decade? That would be impossible also. But that's a problem where if there's a new firm starting and has the latest technology, it can run with that. But then is it interacting with other firms and customers or suppliers or whoever it is, whatever the relationships are among the businesses, that everyone's technology either is not compatible, or whatever the communications issues may be. But that's certainly something that's a very intractable problem. Intractable meaning that it's very difficult to solve, because you can't just put the brakes on the world. And hey, even in New Jersey, I don't know how many of you are familiar, but the New Jersey, the sort of the native New Jersey folks, a big thing in the 70s, and even before, even the 70s and 80s, but even before that, a big thing was to go down the seashore and that was our vacation. It's very nice. Don't get me wrong. The whole Monmouth County, Ocean County, and even points south are very, very beautiful and very, very nice. But the movies, I remember up here, whatever the current movies were, the movies, in Belmar or wherever would be a couple months behind, and we would always joke about that as kids. Say, hey, we saw this movie in the summer or whatever, in the spring or the winter. Now it's considered new down in Long Branch or whatever it might be, kind of a thing. So that's the thing. The gears catching up is always a big problem. The bill's passage means there's more for taxpayers to know, both to counteract recent wild claims and to prepare for what's ahead. So the whole why I like this media count, because there's a couple parts here. There's there's like 5 or 6 parts of it or whatever it might be that I think are really, especially this first one, really point out some really good things there. It says there won't be 87,000 new IRS agents with guns. Okay, the 87,000 hires will happen over a decade, and it'll include customer service reps, technology workers, agents, collections agents that are the armed guys. But that's a law enforcement function. When you're talking about an armed IRS guy, that's basically like a sheriff's officer, or a sheriff's deputy, or something, state police, or whatever it might be. So there's other. It's not just, hey, I made a mistake and we're gonna send someone to your house to break into your safe. Okay, at least I hope not. Hope we don't get to that point. But I don't. That's not what it's going to be. If there's a problem with your taxes, most likely a lot of you will get a letter saying, hey, please resolve this, and maybe you have a tax attorney or an accountant or something that will help you do it. But it's not unless there's a specific where people are intentionally evading and lying to a federal agency, and and at one time that stuff mattered. Now again, the world is so up for, like Mick Jagger would say, the world is so up for grabs now it's not even funny. So if that stuff means anything anymore, lying to a federal agency, whatever that means, these days. But that could be a problem, maybe depending on who you are, right? That could be a problem. And that's the beginnings of communism, right? Show me the person, I'll show you the crime, right? We're skidding to that, which is unfortunate. But here's the big thing, like I was mentioning before, about retiring firefighters and PSC&G workers and court workers and whatever. There's 50,000 retirements expected over the next couple of years. So if you've got 80,000 people, you're going to lose more than half of them. And of course, you're going to replace them with 87,000. So if you do the math here, there's 80,000 people here currently. 50,000 are going to retire, brings you down to 30, and then you hire 87,000 more. So the net change is really about whatever that number is. So 30. So about 117,000 people. So you're looking at 30,000 new, and who knows of those 30,000 who's going to there's no guarantees that people stay with the job, or they could find something in the private sector. and this is, I'm not trying to be awful by saying this. So people who have these state of New Jersey jobs, their big goal is to make, 150,000 or whatever, something like that, right? We want to make 125,000, 150,000, 175,000, whatever. We have, be a director, be this, be that. You have all these sort of goals. And here's just sort of the cold reality of that. If you're an attorney that went to a reasonable law school, a reasonable business school, you have a good head on your shoulders, your starting salary in your late 20s or early 30s could be that number, and the sky could be the limit. There's law firms in Manhattan where guys are making, attorneys are making a couple $1,000,000 a year. Investment bankers are making a few $1,000,000 a year. Who would want a 1960s era technology, highly politicized state of New Jersey, state of New York, state of Connecticut kind of a job when you can be making millions of dollars, serving a clientele who can afford to pay that, as opposed to just being a public servant? Right. So that's also, so, we kind of live in a world where a lot of people that we know really sort of value that kind of a state job and say, oh, well, the pension and this and that. But there's a lot of other pieces to the puzzle. And you got to keep that in mind. Okay. You really got to keep that in mind, that there's a lot of stuff that goes on with this, that, if you're really good at tax, and you guys have, you have some little experience now, which is a few weeks of us working together, you can see what the tax world looks like. And this is always going to be a very in-demand area. Capital management is always going to be a very in-demand area. So I'm not the kind of person, I try to pick something that I like to do and just sort of go with it, and know that there's a sort of a long-term need for it. If there's little, short-term fluctuations, or, oh yeah, the environmental engineers are going to be hired this year, whatever. You can't get caught up in those kinds. You dedicate yourself to something, and you're going to be good at it, irrespective of the oscillations of the market demand. But you've got to be able to look at the infrastructure, the financial infrastructure, the economic infrastructure, the legal infrastructure of the country, and say, hey, how can you, address those needs? And what do you like to do? And that's really what you should be pursuing, what you feel comfortable, what you enjoy doing every day. Then you'll deal with the traffic and the hot and the cold and the heat and the weather and the snow and the rain and the dump truck that almost ran you over on 280 and all those other kinds. You'll deal with all that stuff if you're doing something you enjoy, like me spending time with you guys. I certainly enjoy every minute that we spend together, and questions or happiness or whatever, we can deal with all that stuff. But it's a good use of my mornings and afternoons spending time with you guys. So anyhow, it's just some of the funding's opponents have said 80,000 new agents will be armed, and that's not accurate. I'm sure Fox News says that, but Fox News will like you to think that the government just hired 100,000 people now to break into your house tomorrow and come in with safecrackers, right? And say, hey, what's in your suit? What do you got in there? That's what Fox News is. That's the story. And I'm a Fox News guy, but I know that's the story they're pitching there, which is unfortunate. It says, according to our Internal Revenue Services spokesman, the agency staffers will only be allowed to carry there's only 2,100 special agents in the criminal division. So, yeah, so it's not even, we were looking at those statistics of, 13,000, 23,000, and it's even watered down even more, where there's only a couple thousand special agents in the criminal investigation. Again, criminal investigation division. That's law enforcement. Okay. So Rutgers had police, St. Peter's does it, but Rutgers had their own police department. The NJIT has their own police department, and they can do investigations. They have internal affairs. They have all the bells and whistles of just a normal country police department that you'd find out in Pennsylvania or suburban New Jersey somewhere. They have all the pieces to that. It says they make up less than 3% of the total current IRS workforce of about 80,000 people. So again, you have some of the number, and like I said, I could have crafted some questions around all this. We'll see after the video's over. Maybe I'll go back, because I posted assignment number 2 already. Where is that? Yeah, where is it? These guys. Yeah, here's assignments. Assignment number 2 is 1. Here's assignment number 2, which is posted, and this is for everybody. Okay, so there's 9. Yeah, there's 8 questions here. But I could maybe shoehorn in a couple in here the correspond to the article. I think I probably might go back and do that, because it's not due for a couple weeks. It's due on the 30th, but you have until, actually it's due on the 26th, which is September. But you have until the 7th, so you have a good 2-week buffer to get. And I'm not grading in the meantime. I'm not going to grade it all. Let me send back some graded assignments, and then everyone just copies that. That's just ridiculous. Okay, I started being a professor at night, but it wasn't last night. Okay, so we're not going to be doing that. Okay, that's for sure. Anyhow, a Treasury official who oversees IRS says 1,000 of the hires will be special agents. So, with many replacing departing agents in the late 90s, the agency had 3,500 special agents. So even of the 2,100, and let's say whatever 500 depart, and you have 1,000, it's still below where you were in as she said, in the late 1990s. This is a very good article, and I could, we could really go in circles with this. I might just leave the questions because I don't want to cloud this up too much. I want you guys to spend some time read this, but there's a lot of good numbers in here that help you say, hey, here's what the facts are. Here's what's factual to this particular political football that we're 50 days away from a rather important election in this particular country. So it says the new $80 billion for the IRS over 10 years on top of the agency's annual funding. So for fiscal 2020, which was about 13 billion, so 80 billion over 10 years, it'll bump it up to maybe 20 billion a year or thereabouts, right? Because if it's 13 billion now, 80 billion over 10 years is 8 billion a year. 8 plus 13 is about 21 billion or so. And again, 5 years from now with inflation, the dollars that you could do things with today, you would need more dollars in 5 years to hire more people. So in other words, if you had the nominal same amount of dollars, I don't think this is inflation adjusted dollars at all. You'd be, let's say, if you could hire whatever, what they say they were going to hire. 1,000. So you're hiring 100 people a year. So maybe in 5 years, you can maybe hire 80 people or 85 people or something. Maybe not even the full 100 or something. So those are all things to keep in mind. And you want to be able to do this math in terms of when people tell you something, can you make sense of it? That's very important. So lawmakers could shift annual allocation so that less goes to enforcement and more to customer service. They could also cut or raise this funding. So so depending on who gets in, if the Republican if we're hearing that the polls are telling us that there's going to be a tremendous change in the U.S. Congress this year, but you don't know until it happens. And then there's people on Fox saying, "Oh, well, it's going to be worse than that. So it's going to be even more of a red wave." But that's not necessarily, folks. Let me tell you, there's not a good party and a bad party. There's really not. It's Democrats are bad and Republicans. There's extreme thinking on the left. On the right, there's extreme thinking on the left. Okay, and it just sort of depends on who's in here. And Trump, who's an enormous flashpoint for criticism, and I guess came into government and wasn't a lifer in terms of how governments work and the sort of the reserved attitude of being a federal employee. Even though he was the president, he's still a government employee. The reserved attitude that maybe you should have in doing that job. And people say, well, so disorganized. And you get people who love him, like the Kayla McEnany, say how wonderful. Then you get, there's another, I saw somebody the other day on Frontline, I forget her name, but she was really ripping him. I got to find out how, I got to ask my guys if they know who that is. But she was really, tearing into him something awful that she wasn't. But she said it though. She wasn't making an impact in that particular White House. So apparently it was bad for that reason in her mind. Now, does that mean it was bad for the country, or was it bad for you that you weren't happy that this working relationship didn't work out how you wanted it to work out, and you're just up there? It's just sour grapes. Okay, so you always have to, like I said, you have to read between the lines of what people are telling you. The 80 billion seeks to rebuild the IRS after years of lower funding. Meanwhile, the agency has a backlog of 17 million unprocessed paper returns for individuals and businesses plus correspondence it's behind on, and in part due to the pandemic. I've had unfortunate dealings with various government agencies, and those, I hate to say, but the lower down you go, the municipal level, the town level, it could be, the systems in place could be very paper and pencil still, and we want something written, and it's all those kinds of things. Instead of typed and emailed, people might not want an email. They might just have a paper correspondence, and there's all sorts of things that are that'll that make something like this, unprocessed paper returns for there's 17 million of these, which is not 1, 2, or 3. And how many people do you have working on these things, and if there's a problem with them? So I don't know what the work rate is on this. This is more of a managerial accounting problem, but certainly that's not going to take a day or two to get through that when you have a country of a couple 100 million people and however many returns. And we looked at the data book, whatever it was, 100 million returns or 200 million returns or whatever it may, because everyone's not, your kids and older people aren't. So it's not going to just be it's not going to match the population of the country. It's going to be, I think the numbers were a little bit less. But and actually, just as we're sitting here, where's that data book? We had it here. Here's the data book. Let's see if we can just quickly take a look at that. I want one. I don't like this double page view. View. I don't want to rotate the view, navigation, display. I don't want to have this 2-page thing is sort of popping up all the time. It might be a default of when I got the document. I forgot about that. We're looking at collections and refunds for table 2. Here's table 1. So yeah, so there were 200, and so this is in okay, this is not in millions. This is just as is. Yeah, there's 240 million. Yeah, 261 million. So yeah. So you do the math on that 17. So this is table number. And see, we're using a lot of, I know I posted a lot of documents. There's another document that we're going to talk about today. We're also going to talk about this document. This is 505, tax withholding and estimated taxes. And this has the 2022 table, and our Excel problem is going to be based on that. Okay. So yeah. So again, the 17 million compared to, what came in the door, 260 million came in the door. And again, it's broken down to supplementals or whatever, individuals, C corporation, S corporation. You can get to that on your own time, but you care about the US number. There's and really the income tax document that they were processing was about 200 million or so. So this 17 is paper tax returns. Okay, so that's about 200 divided by that is 6. That's about a 12. That's about 8 or 9% of what came in for the year. So, how fast is that? Are we going to get? And here we go. So now we're getting some. It says earlier this year, the commissioner said he expected the situation to be healthy by year end, but the IRS is processing about 50,000 returns a week at best, and more coming by the 17th. The math isn't favorable. So, okay, if you're doing 500,000 returns a week, oh boy, 500. So that's their rate of being able to process these returns. So in a month, you could do 2 million a month, or is it a million? Is it 2 million? But I'm saying 500,000 a week for 4 weeks is 2 million. And then, so that's 8 months, 9 months, 10 months, a year. You might be a year behind. Okay. There's holidays and Thanksgiving and Christmas and that kind of a thing. Okay, so you could be a year behind on that. So it's good we sort of did the math as we're sort of sitting here. And it says the weekly number of processed returns is rising. Okay. So this past week, a bipartisan group of Congress members sent a stern letter asking to the commissioner for more backlog details. They also urged the IRS to extend the suspension of automated collections and notices, which were pushed earlier because the agency couldn't process. Yeah. So yeah, people may have been getting automatic. It's like if you pay your energy bill and you get a note saying, oh, well, you didn't pay it when you did. And the paperwork just has to catch up. I just dealt with, for my mom, I just dealt with something with the hospital that we paid and they didn't get $271 or whatever it was. So, those are things you have to be able to deal with in a calm way. It takes time for the IRS to staff, especially in a tight labor market. New agents aren't fully productive. Yeah, so that's the other thing. Now, a fireman maybe can get to work a little bit quicker, but even that, you have a house on fire and you're trying to minimize damage to the other houses. Let me tell you something. The water that comes out of those fire hoses, I've watched some of the videos, like people shoot like in New York City, and especially if it's like a wood roof or something, the water can go through the roof and come out the other end. I mean, it's a very, certainly you would never want to stand in the way of the water pressure is dramatic. It's not a garden hose. I mean, it can go there. I've heard that water can go through concrete. So certainly, if you're hitting other houses, if you're in the suburbs, there's a house, there's a fire, a wooden structure fire like down the shore or something, and there's houses right next door, and you start spraying those other houses, you're gonna be knocking off roofing shingles and knocking off siding. So why am I telling you the story? Why I'm telling you the story is it takes a little bit of time to figure out what you're doing as a public worker, certainly law enforcement is a very tricky job, dealing very emotional people and situations, right? That kind of a thing. Same thing with the IRS agents. And this thing is extraordinarily complicated, folks. Let me tell you something. The U.S. Constitution, criminal law, it's far simpler than the tax law area is the most complicated. There's a lot of math involved. If you know anything about lawyers, never ask a lawyer to do any math or accounting because they don't really have a lot of going to struggle with it. But yeah, so that's an accurate assessment there. That's going to take a half a decade, a third to a half a decade to figure to be productive and start bringing in revenues. And also, and it's as terrible as to say, I'm sure these IRS agents, they see who their adversary is going to be. If the guy is very wealthy and the guy is very sophisticated and knows a lot about the tax law, and you've got a lot of cases on your back, and you're going to it could drag on for years, and you're going to spend man hours, and the IRS has to have attorneys, and there's a whole army of people that have to come to court because nobody's, especially if the tax cases are like a valuation dispute, and the case law is on the side of the defendant. Are you going to really go after? Obama even said it, going after these, having government workers go after these very, not the government attorneys are bad, but they may not be the best attorneys out there. I'll just say it like that. And my experience has been that, with, certainly state of New Jersey attorneys, people work on the state side. I think I've known the law better than they have every time. There's been some kind of problem. Not good, right? And you expect these people to be honest and integrity, and to them it's a job. And the worst thing is someone in those situations where that's the only job they have, and their private practice might not be doing so well, and it gets very slippery, because the government does have sort of the advantage where you can't just say, hey, I interpret the law like this, I interpret the case law like that, I interpret yourself. The government's interpretation is usually the one that's going to win. So you got to be careful with those kinds of situations. But in the tax court, it's a federal level, and it doesn't get so personal. At the local level, it tends to get very political and very personal, which could also have an adverse impact on sort of what's going on. So yeah, higher income people. So you have to know who your adversary is. If you're going up against the 1927 Yankees or something, people who are very, very good at what they do, or going after the Patriots for the last 20 years, Tom Brady and the Patriots, that kind of a thing, or LeBron, whatever. You could pick Cleveland or Miami or LA or whatever for him. You're going up against the best of the best. You might want to say, hey, is this really a slam dunk? And folks, let me tell you, the rules of evidence, there's a lot of doubt. Once doubt is raised, and it's a reasonable doubt that can be raised, that's it's going to go to the defendant's advantage. It's not going to go to the state's advantage. Interpretation of the law is more on the side of the state, but if there's a reasonable doubt, then that's kind of that. So anyway, so returns are more complex than lower earners returns and the RSCs. But again, if you're going for lower earners, you're spending time and phone calls and letters and communication and boom and all that stuff. So is it worth it? Is it worth it to go after the roof guy who's a couple $1,000s short on something? So the methods, the audit methods are not minor. Yellen and the Treasury have said the new funds for tax enforcement won't increase audit. So again, that's the political angle. But if you're making less than 400,000, we're not going to come after you. But most people are making that's like a magical number somewhere, and that there's meaning. Believe me, the government knows, because the Social Security Administration, the IRS, they know what that number means. Kind of a situation. So there's some magic about that particular number. Yellen sent a letter to the IRS more specific, saying that new funding shall not be used to increase. Well, I mean, she's not a lawmaker. Okay, she's the Treasury Secretary, but she's not a lawmaker. It said shall not be used to increase the share of small business or households below 400,000 threshold that are audited. Now, she could be a policy person, but there's no law that says you can't audit this person. And when she's not young, so she may not be around for very much longer. And how binding is that going to really be? And people at the IRS said, okay, well, when you're out the door in a year or two, we'll see you later. Because believe me, Yellen's not going to be here for the next. If Trump gets in again, or DeSantis gets in or something, they're not going to keep her. That's for sure. So that statement could be to the wind in a very short, couple of years. The Treasury directive leaves room for audits of taxpayers claiming, say, 300,000, another 200,000 of unreported income. Well, you start adding up and say, well, you're claiming 3, but we think there's some more unreported. We have an anonymous source that says you have some unreported income. So the bottom line says, for honest taxpayers earning less than 400,000, the chance of being audited are going down. And again, our first assignment, you guys looked at the number of Asians, the percentage of audits. You had some sense of that. And like I said, we're going to go through we're not necessarily going to do today, but just here very quickly what an audit is. But we're going to go a little more comprehensive discussion as to what an audit is. We'll be doing that very soon. So. Okay. Yeah. Proof of everything. Proof of income, proof of deductions, proof of tax credits. Okay, so if you've got a paper trail saying, why you're getting paid, and why your deductions are what they are, and why your tax credits were what they were, and you say, look, to the agent, or to the agent, it's going to be the person on the phone. Folks, let me tell you something. I had some tax stuff with the state of New Jersey where we owed whatever, and I wanted to make a payment plan. I don't even think I spoke to a person. I called some phone number my tax preparer gave me, and it was all automated, and there was no person that I spoke to and said, okay, fine, you want to pay $100 a month or whatever, no problem. And it was an automated recording with they're probably answers to all the potential outcomes that were just pre-recorded by state of New Jersey employee or whatever it might be. And that's it. And I didn't talk, and certainly didn't have a personal conversation with anybody. And why isn't an audit? Well, among other things, or what isn't an audit? A letter saying a filer omitted income tax paid by a bank or employer, or math error notice. I've had that stuff, and I've resolved it without even speaking to anybody. That it assesses tax for mistakes detected by the IRS computer. Still, these issues can be scary and require. Yeah, I mean, luck scary. I wasn't scared when this happened because I said, hey, if I owed something, we're going to pay it, and we're going to resolve it. And again, in a reasonable manner. If you start yelling and screaming at these people and making it personal, it's not personal on their end. Even though I mean, there was a whistleblower worked for the IRS saying, "Oh, all these guys care about are their bonuses and their titles." Well, that's true of any state or federal employee cares about that stuff. That's nothing not unique to the IRS. With better IRS systems, the end of a backlog, it should be easier to resolve these issues, but the taxpayers who encounter them shouldn't think that they're evidence of rising audit rates. Okay, so if you're thinking of putting or if you're thinking of putting your tax house in order, it says there's limitations of 3 years for routine issues and 6 years for major ones, but the clock doesn't start running until a return is filed. As of October 1st, the interest rate on most tax underpayment rises annually, equivalent to about 6%. So what is divide that? That's about 0.5% a month in terms of interest on what's owed. So there's taxes owed, and then the interest accumulates on that if you don't make some kind of a deal, some sort of a payment plan with these people where they might not be counting the interest or whatever. The rate resets quarterly, so people with overdue tax payments can still benefit from low rates for prior quarters. There's a lot of good stuff in here. Like I said, I didn't put the I could have put some of these questions, like some of these initial questions in here about the hires and special agents, but I'm gonna leave it sort of as is. But you guys know that this is a real key thing. I just want to leave it here for just a second, so you guys can just take a look at it. But this is a real key area, is to sort of that I haven't heard this as much. But there's only 2,100 special agents. There's going to be there's going to be some of these folks retiring. It says 1,000 of the new hires will be special agents, and then of those 2,100 agents, there's going to be some retirements out of those. Okay, it says there's 50,000 retirements coming, so some of them are going to come out of here. So even if all these people stayed and all these new hires over 10 years added to this, you'd still wouldn't have as many of these special agents as you had in the late 90s. Okay, so you always want to keep those things in mind. The other the other thing I wanted to talk to you about today was taxable income. We'll talk about the IRS at some point. This is tax liability, household adjusted gross, taxable income. This was next. Okay, so this is next. So this might be another assignment, but this is not assignment number 2. But it says, what's taxable income? It's the portion of your gross income used to calculate how much tax you owe in a given year. Yeah, I didn't get to all of these. Oh yeah, right. What's on the video? We're going to talk about this in class. Coming in the live classes. But it says it's the portion of your gross income used to calculate how much tax you owe in a given year. It can be just described broadly as adjusted gross income minus allowable itemized or standard deductions. Okay. Yeah, that's taxable income, right? It's your adjusted gross. Then you subtract out your deductions. Okay. And anything that subtracts out from that becomes so taxable income includes wages, salaries, bonuses, tips, as well as investment income and various types of unearned income. Okay. I think that those are some questions that's for assignment number 2. There's a set of questions right there. It says, what is I'm saying, or actually this was in the previous set of notes went over something similar, but this is so for assignment number 3 or whatever, these could be some good questions here. Okay, so tax is a portion of the gross income used to calculate how much tax you owe in a given year. It's adjusted gross minus. So again, once you go from gross income to adjusted gross income, you subtract out deductions, and then you get taxable income. And like I said, I'm sort of saying it in words, but we're gonna see how this unfolds when we hit our problem sets, which we have a significant number of problems. I'm looking at the calendar. We're already into it's going to be September 19th. We have 2 more weeks in September and another 4 in October. So we got to be in the next 6 weeks. We really got to get a lot done in the next 6 weeks. It's a portion of your gross income that the IRS deems subject to taxes. Is taxable income. It's both earned and unearned income. Unearned income means you have some sort of payment that came to you, and you didn't provide the product or service for that. That's not going to be a lot of That's a little more of a sophisticated taxpayer. Most of us don't get a check without doing something for it. That's not most people. Okay, but that does exist. There's prepayments and things of that nature. So, but that gets into a little more complicated tax scenario. Taxable income is generally less than adjusted gross income. And actually, we didn't go through. I'm looking at this. We didn't go through adjusted gross yet. I think that's next. Yeah, I probably should have done adjusted gross first. Okay, we'll do this one first. That's fine. And like I said, and we'll go back and relate. So, okay, when we talk about taxable income, what does that really mean? And actually, if you look at your problems for the assignment, right, you're here with this thing. You taxable income. This is after adjustments and gross income and stuff was deducted and whatever. Tax credits happen. A tax credit gets applied after you get your taxes owed, but a deduction happens at this particular point where you're arriving at taxable income from adjusted gross, and adjusted gross is what does count as tax and what doesn't, and then you take out the deductions. Okay, but like I said, we'll go into that in future videos. It says taxable income consists of both earned and unearned. Unearned income is considered tax to include canceled debts, government benefits. Okay, so it's a little broader definition of unearned. I was going to say government benefits, strike benefits, lottery payments. So it means you didn't necessarily do something for, but generally unearned revenues, unearned income means that you're prepaid for something that you have to deliver in the future. If you're winning a lottery, you have no commitments outside of you bought the ticket already. You're just expecting those payments, and that's it. Okay, so there's a little broader of a definition of unearned income. Taxable income also includes earnings generated from appreciated assets that have been sold during the year and from dividends and from interest income. Okay, so all of that stuff is so your assignment number 2 taxable income plays a very big part of that, and we're gonna test you on this in probably assignment number 3 coming down the road. When it comes to deductions, the IRS offers individual tax filers the option to claim the same deduction, or a list of itemized deductions include interest paid on mortgages, medical expenses exceeding the threshold. So then it gets into what's 7.5% of your adjusted gross income, and your medical expenses exceed that, then you take that difference, and we'll go through I was discussing this with my retired cousin the other night, and I told him, I says that the tax code is more complicated than the U.S. Constitution. Okay, and people make a very good dollar at doing this, and I know this might be a little tough, and I understand that, but I want you to get into this a little bit because this is a tremendous option for you. And there's a long, okay, fine. You know what to do. You made some Excel models. You read some of the IRS publications and all those other kinds of things. But you're going to need to be a CPA or have some sort of credential beyond college, beyond a college degree, to be able to do this. And it could involve standardized tests and things of that nature. And those are very multiple choice versions of things. Okay, so when businesses file their taxes, they do not report their revenue directly as taxable income. Rather, they subtract their business expenses from their revenue to calculate their business income. Then they subtract deductions to calculate the taxable income. I don't know if we're going to get to corporate tax filings in this course. I don't think I think we're just, because I have 140 questions that I really didn't even start yet with you guys. We're just doing sort of the prep work right now. So just keep that in mind. Here's a step-by-step guide to calculating taxable income. So number 1, you want to determine your filing status, documents, deductions, then you have taxable income, and then you compare taxable to non-taxable. So yes, there's a lot of good stuff in this. Okay, number 1, we already had a little bit of a discussion for head of household, single, married, whatever. To calculate your taxable income for individual tax return, first you need to determine your filing status. If you're unmarried, you can file your taxes either as a single filer, or if you have a qualifying person for whom you pay more than half of the support and the housing costs as head of household. And again, there's a complexity just getting through the logic of that. It says if you're married, you'll most likely want to file as married, filing jointly. And there's some limited instances when it makes sense to file as married, filing separately. And like I said, you would have to go through the scenarios with your tax preparer. So what's going to make the most sense for you to file as. When you know your filing status, then you need to gather documents from all sources of income, contracts, and it says any dependents, if applicable, or spouses, if applicable. The total of all these sources of income are known as your gross income. So here we are. Below are the most common tax forms you will need in order to calculate your gross income. The W-2 shows the income you earned, services performed as an employee. If you worked a contract job, then you need the Form 1099. It reports income earned while working for a non-employer person or entity when the amounts are greater than $600. I fill that out very often, these Form 1099s. these are other sources of income, rents, fishing boat proceeds, crop. And so it's very, very specific, right? It says if you earn more than $10 in interest during the year, you want to file a 1099 INT from your financial institution. Okay, so this is what we're figuring out all the sources of income here. Right, this is gross income, which is number two. Number three is your adjusted. Okay, so your adjusted gross. So look at this. It says, contributions to a qualifying individual retirement account, student loan interest, certain education expenses. So as you're computing your adjusted gross income, you're taking some of these above the line. They're called adjustments. You're going to adjust the gross income for, your retirement accounts, loan interest, education expenses. And again, if you don't have any of that stuff, then your adjusted gross and your gross income are the same number. But if you can make some of the adjustments or deductions, but adjustments, then we're gonna, because the next one is really specific, and the accounting for the tax folks are very specific. These are considered, before you get to adjusted gross income, all the distance from gross income to adjusted gross income are called adjustments. Below that, they're called, any subtractions are called deductions. Okay, you can take a standard deduction, you can take an itemized deduction. The standard deductions for 2022, whatever these numbers are telling us here, right? This is 12,950. So this is for 2021, it's 12,550. For 2022, it's 950, 18,800 for 2021, 19,400 for 2022. And then the standard deduction for married filing jointly is 25,100, 25,900 for 21. So you have both years sitting there. And also we have the brackets, and I'll pull it. Actually, this is the tax withholding estimate. We've got the brackets for, I don't know if we have the standard deduction for 2022. I know we have here's the tax brackets here. Okay, we're going to use these because today's example is going to be for tax year 2022, which is the current year that we're in. Do we have standard deductions in here? Let's see if we have them. Withholdings, estimated tax. Here, let's do. I didn't do a. Let's do. I always like to have as many sources as possible. Let's see. Oops. It said it's not in here. Okay. Yeah, this one doesn't necessarily go through deductions, but it's somewhere. We have the tax instructions for 2022. Those we have. Yeah, I'm not going to take time in this video now looking for for 2022 deductions, but these are pretty much the numbers. And I think we looked at we had the instructions in class, and I looked at these. The 2022 are right here. Yeah, this doesn't. I don't know why this just doesn't look IRS like this. Like an attorney got this together or something. Like this is like a tax attorney took care of it, because see at the bottom you have deductions somewhere in here. Where are the deductions? The few pay. Here we go. Filing status. Their standard deduction for 2022. Okay, so like I said, this is written like an attorney. This could be maybe the tax code is posted for these particular years. Okay, so what is this? This is 20. Yeah, this is 2022. What do I have? What do I have this thing labeled as? Yeah, 2022, right there. Yeah, 21-45. But these are tax forms 2020. Like I said, we always like to have a couple sources for everything that we sort of talk about here. So, okay. So yeah, anyway, those are some standard deductions. The itemized one, obviously, you need specifics on that, and what can be itemized, what can't be itemized. Okay, and you guys are sort of familiar with that. It says property taxes and mortgage interest paid. These are typically appear in a Form 1098, which you receive from the mortgage lender. If you have no mortgage or don't have an escrow account paying your property taxes, then you need to keep a record of your property tax payments separately, which I do every year. State and local taxes paid. This can be on the W-2 form if you work for an employer. If you're an independent contractor, you need to keep your own records on that. Charitable donations can be tax deductible. Educational expenses can be tax deductible. Unreimbursed medical expenses can be tax deductible. Okay, and then again, it's between 7.5% and 10% of adjusted gross in any normal tax year. That exceeds 7.5% of your adjusted gross. You got to keep that in mind. Qualified business expenses, which allow taxpayers to deduct 20% of QBI, qualified business, real estate investment trusts, dividends, qualified publicly traded partnership income. Again, it gets the deductions get very believe me, this is just a little. this is a drop in the bucket in terms of the whole deduction discussion. What Trump's dealing with is a direct, a direct part of this. What is considered income, what's not considered income, and there you go. So then from there, what again? Let's just sort of go through these from step number one. You have filing status, sources of income, which is your gross income. And again, you make your adjustments to this. The next one for number three, you make your adjustments to this, whatever the adjustments could be, if it's education expenses, student loan interest, or whatever it might be. And then you take your deductions, from adjusted gross income, which brings you to taxable income, which is number five. And it says the final step in calculating taxable income, you'll need to take your adjusted gross income, calculate above, and subtract all applicable deductions. Okay. And then with the American Rescue Plan, whatever it is, the student loan forgiveness issued from the 1st of January to December 31st will not be taxable to the recipient as income. So yeah, this just happened. Okay, so obviously and then we're going to compare taxable income to non-taxable income. Where we're going to look at these. So the IRS considers almost every type of income to be taxable, but there's a small number of income streams that are non-taxable. For example, if you're a member of a religious organization, taking about poverty, work for an organization run by the order, which could be the Jesuits or the Irish Christian Brothers or the Franciscans or the Dominicans, and then turn your earnings over to the order, then you're not taxed. Those properties aren't taxed. Okay, so because that's an enormous service to society, and the government said, hey, we're going to try to cooperate with you on this, and try to make your income work for because those orders are there to feed their brothers and sisters and the priests and whatever it might be. I know in Newark there was the Nigerian sisters had to leave because their income just wasn't enough to keep living where they were living or doing whatever it is that they were doing. They just weren't being supported enough to do it. So they went back to Chicago or Nigeria or something. It says if you receive an employee achievement award and the value is not taxable as long as it meets certain conditions. If someone dies and you receive a life insurance payment, that is non-taxable income as well. So it goes through all the details of what's considered taxable, non-taxable. Different tax agencies can define taxable, non-taxable income differently. The IRS considers lottery winnings to be taxable. The Canadian Revenue Agency considers most lottery winnings and other unexpected one-time windfalls to be non-taxable. Now, that's different countries. And again, if you're a very sophisticated financial person, then you have to worry about, well, are you a citizen of Canada? Are you a citizen of America? Are you a citizen of the UK? What are you a citizen of? And here, there's just a couple questions here. This is what is unearned income? How is taxable income calculated? We discussed this already. You add up the sources of income, you exclude non-taxable items, and you subtract credits. Well, credits are subtracted after after your taxes are due, but okay, deductions. What's non-taxable income? Again, religious earnings from religious orders, charitable organizations, the return to that organization and used sort of communally. Another example can be an employee achievement award. We just discussed this. If someone passes away and it leaves you a life insurance benefit that's non-taxable, okay. And this is unearned income is subject to taxation by federal state authorities. That includes interest, dividends, rents. So unearned means you're out there driving a truck on 280 and almost running me over on my way to St. Peter's, right? That kind of a thing. So that's considered unearned. Means again, dividends, rents, capital gains. Other forms of taxable income can derive from loans that have been forgiven. The government benefits like disability or unemployment benefits and winnings from casinos or lotteries. So, but yeah, those are all taxable. So again, this was a little bit of a conversation about it. This was sort of a Peninsula Hotel discussion. This was not really we need to look at the tax code to really understand what we're what we're doing here. Okay. Okay, we got through two things here. We got through the tax report article. We got through the what taxable income was, and now we'll do our example. We're going to do a 2022 example. Okay, and for similar $80,000 taxable income, and we're going to go through all of that now. Okay, so that the third part of today is going to Excel, which is here. And away we go. So this is the same problem. Now, you're not going to have the same numbers here, but it's 80,000 again. And also what I noticed, what I didn't have here, and I should have, and I don't. Whoops. Oh, yeah, I don't know if I can jam it in somewhere. But you would need a little sort of paragraph like this to um, uh, I don't know. Am I gonna be able to pull this off? Let's see. Maybe. Yeah. Yeah. Cut. That's a big piece that we're gonna cut. We're gonna drop it right there. And then we're gonna come here and actually what I'll do is let me just make this a little bit bigger. This is the answer for what we're talking about here. So this is this tax bracket here. So we're gonna take this. How many lines do we need for this? Taxable income. Copy, paste right there. And then we're gonna take this thing, cut right there. Okay, and then the rest of that stuff we'll get back to it in a second. That's easy to bring over. So okay, so I want to rewrite this. So the marginal rate is still 22. The effective rate is 16.5. I'm just fixing this as we're sitting here, and the tax bill is 217. That's it. Okay, that's all I wanted to do. All the way down, all the way down, all the way down. Cut. There you go. Whoops. There you go. Yeah, so we moved a big piece of real estate. I know you couldn't really see that, but here, that I don't particularly want you to really take a look at that right now. Okay, that's just on the side for me to remind myself what I'm doing here. Okay, so yeah, and with yours here, maybe we could make a little bit of space. I think we kind of have to do the same thing with your version of this. Yeah, sorry. There. This is this. And I'm going to bring in this little uh, sort of summary of what happened here. And now we'll bring it like this. Cut. And we could even leave that other stuff. We could even leave it here for now. Yeah. Because we know it's there. So let's do. Yeah, just to remind us that it's here. Just put a little bit of red there. We'll get it because we don't need that for what we're doing today. So here now again, yeah, I'd like you to get it into Excel and type all this stuff. I've said that a couple times. This is the same 80,000 taxable income. It's the same. Now, what's different? We're in the 2022 tax year, right? And as I mentioned earlier, we have holding. So hey, we have the tax table. Where's our tax table? Yeah, there's our tax table. So single. So this again, this is for 2022. Filing status for 2022. Okay. So I'm going to just put that somewhere where I can sort of get at it, and we could even look at. Whoops, I don't want that. There. Yeah, it's there. So what are we doing? 0, 10,275. Right. That's the first one. $0 to 10,000. That's the first tax bracket. And actually all this. Clearing that out. There. So that's that one. Then this is, 10,276. It's one more to 41,775. 41,776 to 89,075, 89,076, 170 and $50, 170 and $51, 215, 950, 215, 951, 539, 900, right? 539. Oops. Now this is over. Yeah, this is over. And again, someone said, "Hey, well, why'd you put these like this?" And that's fine. I don't mind the criticism of that. Okay. Yeah. All right. So that's your 2022 set of brackets, and your initial 10% is up there. Those are your rates. So what you have 10%, right? 12%, 22%, 24%, 32%, 35%, 37%. Okay, and we'll get to the marginal and all that. So yeah, so we just now again, look, this is just some typing, and this is just some some borders. Right? Remember the border we discussed the borders, right? The cell borders, right? So just make this. That's it. Just type U.S. dollars. Type and make it bold, right? The bold button is right there, and you can mess with the font, but you've got to sit down and play the piano. You have to. You've got to be able to do that. Okay, so we set the table up, and I'm looking here. This matches what I have here. Yours now. This is I'm saying your assignment is for 2021, but this is this is an example of how to do it. So you have two examples of this. Now you're making 80,000, right? So you're going to want to subtract the first bracket, 10,000 minus zero. Okay? The next bracket, you're going to subtract 41,000, not minus 10,276, minus 10,275. Now you're at 80, so if you're not going to be at 89, so you can't subtract that whole bracket. So what you'll do is you'll take the 80,000 up here, right? And then you'll subtract out your 41. So you'll have 38,000 of whatever that, so that's about 75% of that particular bracket. And then what we have down here, we're summing all of our tax amounts. So we want to make sure that we're, and actually, what do we? Yeah, actually, this needs to subtract it from that. Yeah, we want to make sure that that's our taxable income is this, right? That this matches this, and it does, right? It matches, right? So you're 10,000 of the first bracket, 31,000 the entire second bracket, and then about 75% of the third bracket, or thereabouts. Maybe whatever that is, 40. That's 50,000. So yeah, about 80% or so, a little less than 80%. Okay. And then the tax at each rate, this is just simply, you could just say product, just product of these two. 1,028 for the first bracket. Just type in product. Not even putting in the little, this shift 8 for the multiplication sign. The product just multiplies it for you. Okay. Yeah, 3,780. And now from this one, you can just bring that one down. Right, Control D, product of 30,000 times 22%. And then similarly, you want to add, right, the taxes that you're paying. That's your that's taxes owed. And then the tax rate is the taxes owed divided by that 80,000, which is about 16.5%. Okay, so the marginal rate is the same in our little sort of description here. And folks, let me tell you something. You've got to be able to put it in like a letter form too. Everyone's not a mathematician or a tax guy or anything like that. Okay, and so you got to be able to type this stuff out and make it reasonable for someone. So we put the percentages and the taxes owed or whatever. Okay, but so for 2022, what is this guy paying? He's paying 13,217, and this is 13. So he's paying less in the second year with a little bit of expanded tax brackets. And why is that? Well, this tax bracket expanded, the lower ones expanded. So that absorbed some of because the percentages stayed the same, that absorbed more of the dollars of taxes, which is why this is less. And why this is, and the effective rate is slightly less too. Okay, so you have to be careful. You want to be able to do it's hard just on the fly to sit there and say, oh yeah, it's this, it's that. With the tax brackets expanded, the rates expanded. You want to know, what the mathematical impact of everything is. Okay, so those are the three things that we did today, folks. Okay, so you take a little bit of time with this. So we had the what did we do today? So we talked about the article, the 80 billion more for the IRS, what that means, the definition of taxable income, and then we worked out this. We looked at IRS publication 505, which I didn't post it, but you can just go to the IRS website and just type in IRS publication 505 and just download it yourselves. Like I said, me having to post every single thing up there. You guys, and the 2022 brackets are in there. or the tax schedules are in there for the 4 areas. Okay, so again, so this is a dead picture, right? But we did something that was an alive, right? We did this in Excel, and we were able to compute someone's taxes. This little calculator that you made up here. Okay, so you have 2 videos of this, folks. So hopefully you're going to be able to take care of this. Tomorrow I'll make the video for the macroeconomic stuff. So here, so assignment number 2 is posted. So at least this I might add to this. We'll see how I feel, but I might just make some additions to this. But I think for now it's that. Okay, so this is and what this is that little calculator box. There's no graphs in this. But you have to answer these questions, make a cover page, and a couple of people emailed me some stuff that looked pretty good. So you have a double extension to October 7th. So it's due September 26th, but I'll accept this up to the 7th. But that's it though. So the real due date is this, but you do have a little bit of time. But don't because more assignments, and if you're not typing out in Excel, you're really missing. I'm saying it. You're really missing out in the course if you're not making the models as we go along. It can't be too hard to do. It just simply can't be. Okay, so please spend some time with that, folks. Thank you so much, and we'll see you soon.